Well, friends, having discussed the analysis for the investments in our previous discussions and the quality of discounted cash flows, we're now moving to something more important, fundamentally um, intuitive for understanding the sustainability of a project. The moot question of profitability and sustainability is now what we're going to discuss in this session, which would be a concluding session for the series DCF evaluation. In our presentation now, we would be looking at some critical factors, critical ratios, and doing the analysis for both profitability as well as insolvency. Let's begin the discussion with the evaluation of the critical DCF ratios or the discounted cash flow ratios, where we have already discussed the first parameter, the PPP or the business estimate, which influences the profitability and the sustainability of the project. We have discussed at length on this aspect. And now we move on into evaluating some of the other critical factors, and for most of them is cash accruals or liability. We look at cash accruals on liability, which would mean that we are primarily looking at the inflows expressed as a ratio of the outflows. And in doing so, in the first quarter, we got 1.75, we got 1.56 after discounting for the PPP, the 1.67 and 1.97. It's very important for us to understand our accruals vis-a-vis the outflows in our projections based on, again, as I keep reiterating, on the historical cash flows for the lead players in the domain over the past time series. When we look at the liquidity ratio, we are effectively looking at only the cash sales as a percentage of the total liability. We would say the working capital consolidated. Another aspect is it's a summation of the liabilities and aggregation of the liability, and therefore gives out the outlay for planning for an investment or for the cash outflows. So hence, in order to service the cash outflows, we look at the immediate viability, and we look only at the cash component, the sales component, which comes in, which flows in into the fund ecosystem, and we look at the funds as a percentage of the total liability, and that is what we are looking at in when we say the liquidity ratio. We look at how liquid your flow system is, your fund flow ecosystem is, and we have evaluated that the valuation is 0.35, 0.36, 0.44, and so on. 152 in the fourth quarter in this analysis for the polymer industry. So these are in effect the critical discounted cash flow ratios. We then move on into what we call the profitability analysis, where we look at these are the projections over the 4 quarters, as we already discussed, and now what could be your survival threshold. Your survival is for the bare basic survival of the project to sustain the time series that we're talking about. It needs to be at least 25% higher. In effect, it means the inflows must be at least pegged at least at 25% higher than the outflows. In case for generating a margin, a reasonable margin, we need to have a 50% higher value, 50% minimum, 50% higher than the outflows, and for generating a capacity of growth, it should be somewhere around 1.75, that is 75% higher than the outflows. And all of these after factoring the PPP or in the business estimate. So in effect, if we look at the potential, the margin potential, here we have the projection of 1.5, that is the margin, and we look at the value which is slightly higher than the margin threshold, which means that you are in a position to generate profitability. And especially between the third and the fourth quartile, the gap is increasing, which is reasonably a good sign, and therefore it shows that towards the third and fourth quarter, the project achieves some kind reasonable degree of maturity and translates into a higher margin or higher profitability. But now, when we look at the growth potential, we see that our estimated ratio for the accruals as a component of the outflows is 1.75, and here we see that the project is simply achieving a certain growth phase only towards the terminal time period, that is the fourth quartile. In between, in the initial stages, the first quartile, second and third is a period of consolidation, and understandably so. And in the final quarter, we see the gap increasing, essentially implying that towards the terminal points of the timeline, we can estimate a growth, a phase of potential growth and sustainability for consolidation of the sustainability of the project, which is fair enough. So this is how we are likely to evaluate the potential of a discounted cash flow mechanism. And then we look at the insolvency ratios, which is a very important parameter. And we have seen the liquidity ratio is a critical component that decides the insolvency mechanism that could be triggered in an ecosystem of projected cash flows in projects. Now, all of these would be reflected from the real-time analysis of the top line performers in the particular domain over the past. And as I reiterated severally, when we are looking at historical cash flows in a historical time series model for all the lead players in the domain, and we look at the insolvency ratios, the liquidity ratios over a period of timeline, we can gather the market intelligence and look at the level of expertise available at the disposal of the industry as a segment. And we look at the value chain efficiency within the industry and in the context of the macroeconomic fundamentals or various timelines, and eventually home in on what we would rather term as the survival ratio, the operating ratio, or the equity ratio. Operating ratio is where you are generating enough funds, enough cash to have a comfort zone in operating the project, in executing the project, and in day-to-day functioning of the project. So that is what is an operating ratio. Survival ratio is like you are barely surviving day in and day out. It's like a firefighting mode, being in the firefighting mode. In operating ratio, you have a reasonable degree of comfort. There is a cushion available, and so you can operate reasonably with reasonable comfort. And when we look at the equity ratio, it is a phase where you are generating enough cash and enough liquidity in the system, in the fund flow ecosystem, to not only service your liabilities, but more importantly, generate a kind of a reserve fund for contingency and for growth and expansion in activities within the given time period and in the time series. And that kind of expansionary possibility is a measure of the equity ratio. and we home in on a figure, liquidity figure of 0.75, based on the empirical needs, the historical needs of the top players in the domain, as I have reiterated in the past, in the time series of the past. Therefore, looking at these benchmarks, we have now created these benchmarks of survival ratio, the operating ratio, liquidity ratio, to compare the current liquidity ratio projection in the project, and trying to figure out at what point of time would there be enough liquidity in the system given the projected macroeconomic scenario, given the projected aggregated demand and aggregated purchase, and the projected efficiency within the system, within the domain. And we evaluate the values of the insolvency ratios in context of these benchmarks. So if you look at equity potential, this project is way below the level. In a sense, we are saying that within the given projected time series and the quartiles they're in, the the area concern remains that the cash flow, the liquidity ratio is way below even the critical solvency levels, or the operating coverage levels, and more importantly, in the equity potential. So the project needs to bring in expertise to look at the possibilities of improving the liquidity in the system, and let us examine what are the mechanisms for improving the liquidity in the cash flow analysis or in the discounted cash flow analysis. Let's go back to the raw data sheet and look at the outflows, and we look at percentage of credit sales and the cash sales and the realized sales in a given time frame. If we are looking at a higher value realized sales, then in essence we are saying that possibly it all boils down to the quality of the product, the operating efficiency within the ecosystem, and the viability in generating new innovative products to shift the market paradigms, strategic paradigms, and the brand equity of the products within the time frame available for the projected cash flows. So in essence, we are saying the overall efficiency of the project will now get reflected in terms of realized sales, and which in turn will reflect on the cash component of the overall sales scenario. So credit sales will now migrate into cash sales, or credit sales might now migrate into more of certainty to boost the realized sales figure, and that in turn will now generate enough cash to achieve the equity potential. So on hindsight, the various factors related to the project would now decide on the cash component going into the ecosystem, going into the fund flow system, and creating a region of comfort, a zone of comfort for the investors and for the analysts within or all the stakeholders for the matter, to ensure that the project becomes viable and successful. So uh, the bottom line remains, our bottom line reverts around the initiatives to boost the operations in terms of achieving higher productivity, better yield, and generating quality leadership to ensure that the percentage of goods returned, redundant inventory, and unrealized sales potential is much lower, whatever is produced is now converted into sales, and then there is a market perception that brings in more cash sales, or even if the credit sales now gets more of the credit sales gets converted into cash sales and gets realized within the time frame to boost the values of the realized sales. So these are the major factors that have been looked into, that need to be looked into when considering the polymer industry, or for that matter any industry for the matter, and when we are considering the projections of the cash flows. We have to look at the capabilities of the human capital engaged in the project to generate the kind of wealth and maintain what we call or achieve a better insolvency ratio, better insolvency state, or rather solvency state, to put it in a more positive framework. In this particular illustration for the polymer industry, things do not look very rosy from the liquidity perspective, and it all boils down to product engineering and product initiatives for achieving higher cost of or higher productivity and lowering the cost of manufacturing, as we have said. So I believe now the students have got enough insights into understanding the potential of the project. They're looking at the criticality of the project and the profitability analysis, but also not to be caught up only with the rosy scenario or profitability. The profitability might look good on paper, but in this illustration, the insolvency threat is real and very, very dangerous. So I have used the word disruptive insolvency evaluation corner with a purpose, because for all we know, even a very rosy profitability scenario might lead to might be disrupted because of the insolvency factors, and therefore we need to look in detail at the critical aspects of liquidity, and should be able to cover the operating costs and also generate enough reserves for contingency and for expansionary projects or sub projects within the overall framework to accelerate the execution and generate more wealth in the time series allocated for evaluating the project on the discounted cash flows. I hope we have had a fairly reasonably in-depth analysis of the DCF, and the students have had enough insights into what exactly goes into evaluating the discounted cash flow of a project. And please feel free to send me the questions, your queries, or your doubts and your opinions, and then we can review them, we can discuss further on this. Thank you. Have a blessed day ahead. God bless all of us.